Why can't black people afford to buy homes in California? It's 1943. A young black couple stands at a train station in Birmingham, Alabama. The husband just returned from World War II. He wore the uniform. He saluted the flag. He believed the promise. They clutch a suitcase and a newspaper clipping advertising factory jobs in California. Shipyards, aerospace, good wages, opportunity. They board a train headed west. They are part of what historians now call the Second Great Migration. Millions of black Americans leaving the Jim Crow South. Between 1940 and 1970, searching for something simple, safety, dignity, and a home of their own. They believed California was the promised land. But what they didn't know was that the land was promised to everyone except them. This is the story of why so many black families in California can't afford homes today, and how that crisis was engineered, documented, litigated in court, and eerily repeated generation after generation. This is not an accident. It's history repeating itself. Let's start at the beginning. When black families arrived in California during the Great Migration, cities like Los Angeles, Oakland, Richmond, and Pasadena were booming. Defense jobs were plentiful during World War II. Shipyards in Richmond were hiring. Aircraft factories in Inglewood were expanding. But housing? That was another story. In neighborhoods across California, white homeowners used racially restrictive covenants, legal clauses written directly into property deeds to block black buyers. If a home was sold to a black family, the neighbors could sue to reverse the sale. One of the most important cases in American housing history came out of California. In 1948, the United States Supreme Court ruled in Shelley v. Kramer that courts could not enforce racially restrictive covenants. That decision should have opened doors. But instead of opening doors, the discrimination just changed its shape. Banks stepped in. In 1924, a black couple named Charles and Willa Bruce purchased oceanfront land in Manhattan Beach, California. They built a seaside resort where black families could swim, rest, and exist freely at a time when most beaches were segregated. The Bruces had done everything America said to do. They bought land. They built a business. They created stability. But white residents complained. In 1927, the city used eminent domain to seize the property, claiming it was needed for a public park. The Bruces were forced out. Their resort was destroyed. Their land, prime California coastline, was taken by the government itself. The park was never fully built. Much of the land sat empty for decades. Nearly 100 years later, in 2022, Los Angeles County returned the property to the Bruce family's descendants. By then, it was worth millions. Generational wealth had been erased and only partially restored after a century of loss. For decades, lenders and federal agencies like the Homeowners Loan Corporation created color-coded maps marking black neighborhoods as hazardous. This practice became known as redlining. Black neighborhoods were outlined in red ink, signaling to banks that loans there were too risky. It didn't matter if the black family had steady income. It didn't matter if the veteran had GI Bill benefits. The answer was often no. And yes, the GI Bill, one of the largest wealth-building programs in American history, was systematically denied to many black veterans. The bill itself didn't explicitly say no black veterans, but implementation was local. In California and across the country, banks and mortgage lenders refused to approve loans for black applicants, even when they qualified. In Los Angeles, thousands of black veterans were blocked from buying homes in newly developed suburbs. The white veterans moved into places like Lakewood and the San Fernando Valley. Black veterans were pushed into South Central. Wealth began accumulating for one group and was denied to the other. Fast forward to the 1960s. California's black home ownership rate rose slowly. By 1970, many black families who arrived during the Great Migration had finally managed to buy modest homes in neighborhoods like Altadena, Compton, Inglewood, and parts of Oakland. Grandparents bought homes for $20,000 or $30,000. Those same homes are now worth over $800,000. So why can't their grandchildren afford to keep them? Because the economy changed and not in their favor. In the 1970s and 1980s, industries that once employed Black Californians began to disappear. Aerospace jobs shrank, manufacturing left. Steel plants closed, union jobs vanished, factories moved overseas. Just a few miles north in Hayward, California, another Black community quietly disappeared. It was called Russell City. Beginning in the 1950s, Black families, many of them migrants from the South, had purchased land and built modest homes there. Some paid as little as $35 or $100 for their lots. It was one of the few places Black families were allowed to live. Then industry arrived. Refineries, chemical plants, and industrial zoning surrounded the neighborhood. Property values collapsed. Residents were pressured to sell. By the 1960s, the city forced the remaining families out entirely. Their homes were demolished. Their community was erased from the map. In 2022, Alameda County formally apologized and approved millions in compensation for descendants. But the homes and the wealth they could have built were gone. Communities like South Los Angeles were devastated. Unemployment rose, property values fluctuated, crime increased, banks became more predatory. And then came the 2008 foreclosure crisis. Black homeowners were disproportionately targeted with subprime loans, even when they qualified for prime rates. According to studies from the Federal Reserve and Department of Justice, Black borrowers were significantly more likely to receive high-cost mortgages. The result? Black families lost homes at nearly double the rate of white families during the Great Recession. Entire blocks in California were foreclosed. Generational wealth evaporated. In 2022, a Black and Latino couple in Oakland was denied a refinancing loan after their home was appraised at $254,000 or less than a previous valuation and nearly $300,000 below what it ultimately sold for. The California Civil Rights Department later found cause to believe racial discrimination played a role in the appraisal process, leading to a settlement and corrective action. That same year, a lawsuit was filed against Wells Fargo, alleging the bank rejected Black home loan applicants at significantly higher rates than white applicants in violation of fair lending laws. These cases show that discrimination in housing is not just a relic of the 1940s. It is still shaping outcomes in California today. And sometimes, it wasn't even banks that took the homes. It was heirs' property complications. Heirs' property occurs when a homeowner dies without a will. The home is passed down informally to multiple descendants. One relative can sell their share. A developer can buy that fraction. Suddenly, the entire property is vulnerable to forced sale. This has happened repeatedly across the country, including in California. Families who held homes for decades lost them because legal paperwork wasn't updated. Developers moved in. Luxury condos followed. And now we arrive at something even more chilling and downright disturbing. Insurance. Home insurance discrimination has a long, quiet history. Just as banks once redlined neighborhoods, insurers followed similar patterns. Studies have shown that predominantly Black neighborhoods often face higher premiums, fewer policy options, or outright non-renewals. In California, wildfire zones have intensified this problem. In communities like Altadena, historically one of the few middle-class Black enclaves in Los Angeles County, rising fire risks have driven insurance premiums through the roof. Some families have reported being dropped by insurers altogether. After devastating fires, homeowners face a brutal reality. Rebuilding costs exceed coverage. Premiums skyrocket. Policies are denied. And if you can't afford the insurance, you can't rebuild. The eerie repetition is undeniable. This is clearly history repeating itself. Grandparents escaped the South for California to buy homes. They fought redlining. They survived discrimination. They paid off mortgages. Now their grandchildren face rising property taxes, soaring insurance premiums, stagnant wages, and an unforgiving housing market where the median home price in California exceeds $800,000 statewide and well over $1 million in many counties. The black home ownership rate in California today remains dramatically lower than that of white households. According to U.S. Census data, black home ownership in California hovers around 34%, compared to over 60% for white households. That gap is not random. It is the accumulated result of denied GI Bill loans, redlining and predatory lending, also jobs that were lost due to deindustrialization, Harris property vulnerability, insurance discrimination, and climate-driven rebuilding costs that are out of reach and expensive. Wealth is not built in one generation at all. It is built across them. And when one generation is blocked, even partially, the ripple lasts a century. When you think about why can't many black people afford houses in California, it goes way back in time. The better question is, who built the system that made it this way? The train in 1943 carried hope westward. So many black families wanted a better life. But that train also carried a promise that America never fully kept. Scope News tells the truth. Here are the facts. Historical data from U.S. Census Bureau home ownership statistics, Federal Reserve studies on subprime lending disparities, Department of Justice settlements under the Fair Housing Act, historical documentation of redlining by the Homeowners Loan Corporation, Supreme Court ruling in Shelley v. Kramer, 1948, academic research on GI Bill implementation disparities, and reporting on California wildfire insurance market withdrawals and Altadena rebuilding challenges were used to inform this report. Legal disclaimer. This content is presented for educational, informational, and journalistic purposes. It reflects historical records, publicly available statistics, and documented court cases. While every effort has been made to ensure accuracy, some data may evolve as new research or policy developments emerge. This report is not legal or financial advice. Viewers are encouraged to consult primary sources, legal professionals, or financial advisors for individualized guidance. Viewer discretion is advised when engaging with topics involving historical discrimination, economic hardship, and systemic inequities.